Welcome to Chapter 2 Asset Returns, Interest Rates and Fixed Income Securities. In this chapter, we will talk about financial markets and financial data, calculation of asset returns and compounding, interest rates and basics of bonds, yield curve, interpolation of the yield curve. Let's start with financial markets. Financial markets consist of a wide range of financial products, and some fundamental asset classes include stocks, equities, basically bonds and commodities. But we also have more complicated or derived assets such as futures, options, and some other asset-backed securities which might be synthetically created. Financial data and data processing is very important. For example, if you are working with the futures prices of, let's say, cotton or some other commodity, then there will be multiple maturity contracts for the same underlying asset. So you will need to consider the rollover issues when you want to construct a continuous time series dataset. In the financial data, tick data is also quite often commonly used these days. And every exchange keeps tick level order book, including all the matched transactions and waiting orders on the buy and sell side. So here tick refers to the minimum upward or downward movement in the price of a security. One of the important questions when we do financial modeling is which frequency of data we should use. So the answer to this question depends on a variety of factors such as the asset type, liquidity of the asset, trading horizon, execution speed of trading algorithms, and so on. But in this course, I will show you a variety of examples in which we work with both high frequency or low frequency data depending on the problem. For example, when we do risk modeling, we might be using the daily data or in some cases weekly data. When we are testing some trading algorithms, preferably we will be using higher frequency data such as minute data or seconds level data. So here is the order book. This is how it looks like. And in the order book, there are two sides. So we call the ask side, this is the sell, and this is the buy side. There might be different number of levels that you can see in each sell and ask side. And what does this structure means is actually quite simple. You can see that on the bid side, 100 shares are being offered from $99.95. 50 shares is offered from $99.90 and so on. And on the sell side, people are willing to sell 1,000 shares from 100. They are willing to sell 500 shares from 105, and another 100 shares people are willing to sell from 100.10. So it shows that at different prices, there are different number of shares available to be bought or to be sold. And given this, keeping this order book in your mind, there are different type of orders that you can execute during trading the stocks or commodities and so on. One of them is the limit order. So basically, if I go back to my order book, if I give a limit order, let's say to sell this share from 100, let's say I enter a limit order to sell from 100, let's say 200 shares. So this is gonna add to here and it will be 1,200. And similarly, if you give a limit order to buy, it will go to the appropriate section here, depending on what's the price that you enter, and it will update the order book. So this is how the limit order works. The market order, sell or buy from the existing market price. And remember, by just giving a limit order, you cannot execute a trade. important thing is someone else should cross the spread. For example, if I want to make sure that I can buy this asset, let's say this is IBM stock. If I want to make sure I can buy this asset, then I should cross the bid and I should go to the ask side, which is the best price is $100. So if I pay $100, I can buy up to 1,000 shares. But if I want to buy, let's say 1,500 shares, then paying 100 will not be sufficient to make sure I can buy, and the remaining 500 will be executed from 105. So in other words, the more I want to buy, the higher the price is going to be pulled up. And you can see some example. Market order to buy, let's say 1,100 IBM shares, assuming that this is IBM shares. You get 1,000 shares from the available quotation of 1,000, then the remaining 100 shares should be bought from the next level, as we said, is 105. And the similar example you can imagine if you want to sell the IBM shares, then you will be moving towards the bid side of the order book. Crossing the spread, for example, writing a buy order from 100 means you are crossing the spread, or if you are writing a sell order from 99.95 means again you are crossing the spread, so the transaction takes place. Also note that as an investor, we are not directly buying from the exchange itself, but we are writing our order with our intermediary broker or dealer. Often the exchanges only allow for the basic order types such as the buy, sell, market order, and limit order. However, if you work with a dealer, then they can offer you more complicated order types as well. Finally, I want to talk about short selling and stop loss. Short selling means basically you are borrowing the shares from someone else and selling them, and you need to give back the shares at a later time, speculating that the price of the share will go down in time so that you will make a profit from this transaction. So in this case, you have the cash and liability in this situation because you borrow the shares and you need to give back the shares later on. Another important term is the stop loss, because whenever we trade, we need to introduce some stop loss levels in order to put a maximum cap on the potential losses for our positions. For example, if we want to lose at most 3% from our portfolio position, then we need to put the stop loss order around this 3% lower than the price we bought the assets. Thank you.